Amisha Vora joins us. Let's connect with her. It's been a while we have not interacted with her on the show. So Amisha, great to have you back. Thank you for joining us. The bull run continues. Do you think this is as good as it gets for 2023?
The bull run continues, and how? I think the best part of this bull run is the breadth of the market. And it's so very well supported, if you see this time round, by the corporate results also. We can see that at wide range of industries and companies, margin improvements are seen across mid caps, small caps, and I think that's what is very, very well accepted by markets, apart from, of course, all the macro reasons.
So Amisha, why have markets gone up by 2,000 points on the Nifty? Is it only the magic of global liquidity? FIs are back and markets are up. I mean, is it as simple as I'm trying to make it sound?
No, I think one of the key reasons also is that, particularly from interest rate perspective, our real interest rate is already positive, which means that threat for interest rate hike is very limited for us. And if things work out, maybe this is the peak of interest rate that we are seeing. So that's the first point when you start to recognize that economy will not have any further jolts because of the higher cost of capital. Having said that, a lot of people, a lot of investors globally tried flirting with China being cheap and it's just opening up. But as you know, nothing is working out. So right now we are in a situation where the domestic savings and domestic monthly SIP is steady. Negative inflow, or rather outflow from FIIs, is not only neutral, but there is positive money trickling in. And it's not yet like a storm, but small money has started trickling in. And this is where we are. I think this is the two main reasons for our 2000 point market rally, apart from the fact that corporate results have also supported well.
Okay, point taken. Let's welcome on board.
Amisha, just wondering whether it's now time to tread a little bit with caution, or do you think that FOMO feeling will keep the market gains intact and one can still get into some of the stocks, even if they are frenzied or overvalued, and still make money?
So I think on a slightly broader basis, there are two things that we need to be slightly cautious about. One is at the beginning, sometime back, we heard about El Nino. Right now, it's once again predicted to be a very normal monsoon for us. So if El Nino does not happen, I think the momentum in the economy will continue. And of course, there will be some disturbances here and there because of the election outcomes, because a lot of states are going into elections. And of course, we are going for our Lok Sabha elections also beginning next year. So these are the two worries on the horizon which can keep a check on the markets. But the underlying of the economy is so strong that I feel still the markets would continue to be buy at decline. And, earlier it proved right that 16,200, 16,500 appeared a couple of times as a very strong support. So in this journey where we as a research house feel that 20,000, 20,250 is not an impossible task or a target for us in a year's journey, we think that a buy at a decline will continue to be the right strategy.
You are essentially saying that 20,000 before 31st of December, before Santa comes, Nifty will be at 20,000 plus.
It's a yearly target. So before Santa comes, we all would love it. But generally, we keep it April to April types. So post-election, maybe.
Quite bullish on Amisha's the entire manufacturing vertical, right? Whether it's a Dixon, Amber, Sirma, Keynes, you name it, all of those stocks have given you returns anywhere between 20 to 40, 50% this year so far. What's your take on this entire space?
So, they're finally seeing the whole PLI rolling out. They've been getting the checks from government on the PLI, and our broader vision to get maximum of things internally produced is also coming true. I think some of these trends are not cursory. These trends will become bolder by the day. Yes, sometimes prices run up a bit in advance, but I don't think these are the times when one should book profits and go back, sit home. These trends will continue to pick up pace and grow.
Would you believe that the worst of IT could be behind, and if someone hasn't participated in the rebound in IT, should they?
So, from price correction perspective, I would say that broadly, yes, the correction is behind. I would think that, of course, price is a leading indication which takes the lead before the order pipeline, visibility, or numbers come in. But still, I wouldn't see a runaway rise in the IT packs still. I think it's time before that becomes overweight across portfolios. So it's more still a time to keep focus on domestic focused businesses and industries.
All right. Majority of the market men are of the view that one should stay with large banks, and that was the view 2 years ago, that was the view 6 months ago, and that was the view now also. But the real market action has shifted to an AU, IDFC First Bank, to some extent Kotak. Do you think big banks are great, but the real percentage gain actually would be in smaller banks?
Nikunj, IDFC First Bank in particular, if I take up, they have a very differentiated offering. On one hand, they have asset book, which is high yielding like an NBFC. And because they are bank and they're successful in building their fixed deposit, whether CASA, out of CASA or term, their cost is equivalent to a bank. Last 2 to 3 years after becoming from an NBFC to bank, they found a lot of challenges from the past book and COVID. Now, as we stand today, I think their growth will be very rapid in terms of ROE improvement, in terms of their book value addition, and so also their price appreciation, because the model is time tested. So this particular bank, I think, is going to be in a very, very strong business up move from here on, and profit delivery will be very strong. I wouldn't say that every other small bank that I would be looking at, because they have to have a slight niche to survive. When HDFC and HDFC Bank merge, the pressure on deposit will continue to be high. In that case, to survive that CASA or low cost deposit or have something to lend at a higher yield is going to be very differentiated. So I continue to be bullish on IDFC First Bank, but apart from that, of course, HDFC franchise, when it merges, it may take time, but it will throw phenomenal growth for next 2 to 5 years.
In this entire uptick, Amisha, HDFC Bank has been left out. Now it is an FI dominated stock. Reliance Industries has been left out. It's an FI dominated stock. Infosys has been left out. It's an FI dominated stock. So if FIs are back, I'm surprised what are they buying? Because historically when FIs are back, first they'll buy HDFC Bank, then they'll buy Reliance, and then they'll buy Infosys. Right now they're not buying all three. Chal kya raha hai?
Their interest is also, and they've realized, as I keep talking and meeting, of course, long only have to have a large cap view, but otherwise the general allocations have also started looking at. The hedge funds wants to allocate back to India. So I think the interest will be non-absolute large cap also when this tickling in of FI money is happening.
To play the entire consumption story in India at this point of time? Is it the likes of Trend? Is it some QSR names that you like? Or is it the good old likes of ITC, etc.? Amisha, the question is for you.
If you're asking me, then I feel that I'll be more comfortable with the domestic consumption, but that part which is durable. Because last year, this time, they had huge pressure of commodity prices rising. And also because of the overall inflation being high, the purchasing power was also getting constrained. If I see vis-a-vis that current year, the margin will have a lot of support because of the commodity prices across, whether it is oil and energy related, whether it is ferrous, non-ferrous, whether it is soft commodities or chemicals. All the prices are much sober, giving a very good support to the margins. If whosoever has taken a price rise, that becomes an additional cushion to push. This being election year, different states will start spending, giving some schemes, offers, etc. So I feel that, I would feel that I wouldn't be in pure FMCG. That also will have a margin trigger, but slightly beyond that. So it's starting from, it is not I would say non-durable Pidilite, right up to going to all building material suppliers, some of the structured steel manufacturers which provide to infrastructure, actual other manufacturing too, which goes for consumers within the basket, wires, cables. I think this entire pack will continue to do very well. And that's where one should continue to focus.
Right. Great to have you on the show. Arpit, Naresh, we'll let you guys go as well on that note. Closing in